Good morning, guys. Matt from Blaze Capital here. So today we're going to go over the iron condor option strategy. So what an iron condor is, it's a strategy where you're hoping that the stock isn't going to move to your outside strikes. So you want the stock to just chop in between a zone. So what an iron condor is you sell a put and a call on each side, and then outside of those, you buy a put and a call on each side. So that's in order to protect your risk and give you a max loss. So what I have up here is a picture of a Twilio, the chart. So this is a iron condor that I put on with another guy that's been helping me learn these. His name is James. So the idea is to sell a put and a call on each side. So the ones we sold were a 155 call and a 160 call we bought, so that hedges your risk, so it gives you a max loss. And then you sell a put down here, excuse me, and then you buy a put here to cover your max loss. So if we go over here, so you're going to collect a credit, same as if you're doing those credit spreads we looked at before. So the idea is, I can't see that very good. I can't move it now. There we go. So you sell these for a credit. This is an actual trade that I have on right now. So we have our max profit, which would be, we got 182 credit for this. And the idea is you want to sell these and then buy it back later. And the idea is for the for the stock to just stay within that trading range, and then you can buy it back at whatever point in time. So with this strategy, typically we look to get around 50% of max profit. We usually buy them, like 30 to 45 days out, from the date of purchase. So for this one, for example, we bought it for the August 16th strike, and then we purchased it right around here, so on the 5th of July. Or sold it, whatever vocabulary you want to use. Okay, so as you can see here, max profit is 182. So you would receive that profit if the stock closes anywhere in between your 115 and your 155 at expiry. You can hold these to expiry, just like if you're going to hold something that long, like if it's still staying within your trading range, like, so for us it was somewhere around 140. If it's still floating around there, you can keep holding it. But if it starts getting towards your, like one of your upper or lower limits, then you might want to start looking at selling early. But in general, we usually just look for about 50% max profit because, like anything can happen, and you definitely want to pay attention to earnings and all that. So we also get our max loss here. So max loss is $318. So that would be if it goes outside of either of your wings. So 160 and then 110, that's going to give you your max loss. So with that, you would get obviously your max credit from the put or call side, and then you would take your max loss on the opposite side. So with these, typically you're going to be biased one way or the other depending on where you're buying and like where the market thinks everything's going to go. So for this one, these are my actual purchase prices. So the call side was a little bit more expensive. So there's less total credit here to obtain, just slightly. So your max loss is going to be a little bit faster towards the put side than the call side. Or sorry, like if it goes up towards the calls, you're going to lose a little bit more than if it was towards the puts. Okay. So as you can see here, yep. So we're going to sell each of the calls and puts, and then buy the puts and calls above it. You don't have to do $5 wide. You can do $3 wide or like whatever the stock, like whatever is available on the stock price, you can do. This is just going to change your max loss and max profit. So your max loss is going to be lower. But if you're not going to get as much credit, then your max profit will also be probably lower. For these, you got to keep your commissions in mind too, because you're going to be buying and selling. So just for one iron condor, it's going to be 4 securities, whereas with one of the vertical spreads, you're going to be only doing 2. So it's going to be obviously more expensive in your commission. So you have to make more to cover it. So for me, I pay $4.95 plus 75 cents per contract. So for these, I need to make like around $20 to break even. So for credit, I usually like to look for somewhere up in like the high $1 range, and then for smaller ones, I'll have to do more contracts. So if it's like under $1 for that, I usually do two iron condors instead of one, because the credit is not worth it if you're paying commission. So if we go over here and look at the option chain, the other most important thing to look for when putting on one of these is the implied volatility. So the implied volatility is the premium baked into the option price. So people are like betting that it's going to go up or down depending on which side. So these are both pretty high implied volatilities. So this is what you're looking for with an iron condor, because this is what money you're trying to capture. So when people are paying extra, you're selling that credit for a higher price, and then the idea is for this implied volatility to drop and theta to drop as you get closer to the expiration. So say this drops down to like 30% or whatever, and it's going to have a dollar value associated with that, and then you want to buy the iron condor back for cheaper than what you sold it for, and then you get to net the profit. So that's kind of the whole theory. I read a couple of statistics. So generally, like you want over for iron condor, like I wouldn't go much lower than 40% implied volatility, because even if you're right 100% of the time, the amount of money you're going to capture for the credits is not going to offset your commission and everything. So typically you want to be looking for 50 plus implied volatility. And in general, you want to be trading the monthly expirations, because there's more liquidity. And when you're doing this, you're trying to buy and sell 4 securities at once. So you want a lot of volume, or else you're going to have a really hard time getting in and out of this. And then same thing. So you put in typically a limit order if you're going to buy all these. So is it going to let me show this? Yeah, okay. So you're going to have your order up here, and then you are going to put in a limit order. So for us, like it was 1.82, and then that's how you're going to send your order in. So every brokerage is different. Sometimes you might have to put the orders in individually. With Questrade, it lets you just put in the order with a total limit. The problem with this is sometimes you're not going to get a great fill on one of the legs, leg meaning the put or the calls. So I had a trade the other day, and I was like super upside down on it because I got filled really bad on the selling price and really good on the buying price. So what that means is it was a lot more biased. So it took me a long time to get my profit out of that trade, because I was just like the other call was I was way more down on the call that I bought than I was on the call that I sold. And it just took a very long time for those to reach equilibrium. In those situations, you sometimes have to hold to way closer to expiration, because there's just like so much bias towards one of your strikes. Okay, so in this situation, you would just send it, and then you see if you get filled or not. And then sometimes you have to walk it up or down. The idea for these is you want to get as much credit as possible. So sell it as high as possible, and then buy it back as cheap as possible. So, all right. Cool. I don't think I have anything else to go over here, guys. So just summary points. You have a max loss and a max profit. You want the stock to stay within the ones that you sold here for max profit. And generally, you want to buy these back cheaper, usually somewhere around 50% or so, whatever your strategy is. You can also do these with daily expirations. So sometimes do them on the SPX. But those, like, you're only going to get around like $1 credit, so sometimes you have to hold it to the end of the day, which is a little scary. You just want to make sure you're going out wide enough so that you're not going to get hit either direction. And then, yeah, so if you guys have any questions, just shoot me a message, and yeah, hopefully you guys are liking these